Hello, everyone, and welcome to this week's podcast from July the 18th. We're actually recording this on the 17th, but it'll be coming out on the 18th. My name is David Clark, and I am joined by Miles Clark, and we are looking forward to getting to talk about some charts today.
Yeah, it's going to be fun. We're going to do our five charts. David and I discussed yesterday as we were talking through the plans for today. We said, should we or should we not eat a burger over the podcast? We ended up flipping a coin on it, and unfortunately, we're here without hamburgers.
Yeah, you
So,
don't get to listen to us chew in the
yeah,
process,
ASMR
but
of
yeah, I mean, it was a possible curveball we could have thrown at folks though,
go to
to see who's listening.
viewership just goes through the roof. They're just like, oh man, we've opened up a new topic. We
We
found a
talk
new
about
burger.
investment ideas and food reviews.
All right, now that is not, and this is convincing. Regardless, though, no cheeseburgers, unfortunately. Maybe next week, or next time you're in town. But we got a lot of stuff, fun stuff to talk about this week. Second week of the quarter, in terms of busyness from the first couple weeks of the second quarter in April, right, versus the second quarter of or excuse me, the wow,
Third quarter.
third quarter, been pretty quiet so far, right?
Yeah, I mean, comparatively, for
Comparatively,
sure.
yes.
Yeah, and I mean, we're getting earnings kicking up now, which has definitely provided, I wouldn't say as much of a catalyst like we saw back then, to your point.
Right.
But I mean, we're at least getting some things that people are watching. And right now, banks and airlines have kind of been the primary focus this week. At least airlines sort of starting last week, but carrying on over into this week. And this week was just it seemed like every major bank reported this week.
Yeah, they always get it started, I mean,
Hmm.
so we look forward to next week. You've got the names like Google, Tesla, IBM. So that'll certainly probably be an
Yeah.
exciting week as well. But from the earnings front this week, you got the big blue blood banks, JP Morgan, Morgan Stanley, all those guys. You mentioned or the chart for today specifically, but you can really plug and play any bank in
Yeah,
that one.
pretty much almost
Yeah,
because there was a lot of similarities in their reports.
right.
I mean, in the fact that positives, less uncertainty, but there were a few banks that it sort of seemed like, how did net interest income end up for a lot of banks? That's sort of an important metric for them. And the one that really kind of came under fire was Wells Fargo. And even then, like looking at Wells Fargo's chart right now, that's a reversal down from highs, is
Yep.
what we saw. While there's something to that fundamental story potentially that you just sort of have to wait and see till next quarter. Even then, the technical picture is not really like it's breaking down by
Right.
any means. A lot of charts that we're probably going to end up talking about, we're going to be talking about pulling back from highs.
Right.
You know,
And that's ultimately a very good thing. I mean, you look at Wells, again, five for fiver, but again,
hmm
plug and play any bank here.
JP
Technically
Morgan.
strong. JP Morgan
Yeah.
kind of fallen off a little bit. Goldman's very similar type of
hmm
conversation. These guys are all relatively overbought, as much of the market is. That's
hmm
a little aside there. But getting pullbacks, most of the time, it's going to be dependent on client situation and things like that. Most of the time, these are going to be constructive
hmm
and attractive opportunities into high attribute names. Now, again, dig through all you fundamentalists out there, go dig through your 10Ks, have fun with them. But again, from the charts, getting pullbacks out of these highs, five attribute stocks, not necessarily a bad look. Let's put it that way.
Well, and I mean, even then, looking at that fundamental piece of it, it's not like you're looking at a bunch of X's on
Right.
the report or any bad things that sort of sent the stock lower
They're
on
still in
purpose.
business.
Yeah,
Yeah.
yeah, they're still in
Yeah.
business. But I mean, we saw positives out of those earnings, kind of pullbacks, or at least kind of consolidation, really,
Yeah.
probably for many of them. But then Airlines also came into the fray and took a little bit of limelight there for a few days. We saw some positives out of Delta as they reiterated or restored their guidance. They cut it in Q1 and now they restored it for the
I'm
rest of
just
the
kidding.
year. Yeah. They're like,
Joke,
you're
guys.
kidding. It's all right. We're back. We're back. But it's interesting to the extent of seeing that restoration of guidance because Delta did it and saw one heck of a rally.
Right.
Fast forward to this week, we see United do it. The restoration of that guidance wasn't quite what many may have expected. So
Right.
we've seen the stock at least initially it fell off today has now rebounded tremendously. So, there's definitely some undercurrents going on within the airline space that you can tell are sort of pinned to how tariff conversations going? What's going on here? Is it influencing how the consumer's spending, so on and so forth? And they are at the mercy of that conversation for
Yeah.
sure.
Watch this. Shameless plug. If you're talking about travel and how well airlines are doing, come join us in Nashville for our catapult this October. It's going to be a heck of a time. It's going to be a comprehensive, essentially from point A to point Z, learning what the X's and O's are, learning, how to use Dorsey Wright and stuff like that in your practice. So certainly will be a good time. Back to it though, jets, right? And we talked
Mhm.
about Delta, United, those guys. Jets is kind of primarily airline and maybe some are there any defense guys in there or is that
Mostly for them, it's kind of a components piece,
okay?
but you tend to see it overweight the airlines
Right, right, right.
in its case. I mean, as you're alluding to, we've seen it rally, give a third consecutive buy signal, and get up near the top of the trading band in overbought territory, like a lot of charts. But at this point, haven't seen it quite pull back like some of those individual airlines have done.
Right. What's its weekly overbought? Is it overbought right now? I mean, it's
It
up there on
is.
that. Yeah.
It's at about 60%, which is like that borderline
Okay.
for us,
Yeah. But still, technically strong fund score. You're sitting there around 5.3 or so at the time of this recording. It's coming up on an interesting point of resistance. Those kind of highs from 2025 from earlier this
Mhm.
year. So possible, again, being a bit overbought. A lot of the kind of underlying constituents, they've seen massive rallies up over the last week or so. Probably makes sense for it to pull back a little bit or at least normalize. And kind of just play around in current levels for a little bit. But again, extremely constructive moves. And then, like you were talking before, some of those components names, the guys who actually make the
Mhm.
nuts and bolts that fall off the plane sometimes, those guys are doing pretty well too.
Yeah, and I mean, you can even look at something more just general aerospace defense, not particularly jets like this, but even then, you and I went back and forth yesterday with about 4 or 5 names that we
Yeah,
just looked at and were like, dang, that looks pretty good too. That's
right.
pulled back here recently. So some of those aerospace kind of components names, don't forget about those either, especially in this
Right. Well,
conversation.
and that gives before we jump onto the next chart, that gives a decent opportunity to talk about industrials. And then, you kind of have airlines as like industrials, consumer
Mhm.
discretionary, whatever it is. Industrials very quietly putting together quite a year. And they've been a Dorsey Wright overweight within those Dolly rankings or kind of sector rankings for the better part of the last year. So it's been a very strong sector. And again, just another feather in the cap as we open up the back half of 2025. I almost said 2023 there. I don't know where I was coming from. But yeah, we are in 2025.
It's been an interesting start to the week.
Yeah, get me going. What's the next chart? Keep us going.
Well, at this point, we've talked about earnings, seeing sort of mostly positive fundamental earnings reports, seeing some rebounds out of names, consolidation out of others. But what's one interesting piece is we've watched market indices like the S&P 500 and some others move to new highs. And yet we've seen a decrease in participation this
Yeah,
week. So we saw the bullish percent for the S&P 500 reverse down in those following yesterday's action down there to 68%, sort of matching where it fell to in June. Still an elevated level, by no means what we would say concerning at this point,
right.
but sort of that first feather in the cap that we're like, okay, now we're going to watch that one too.
Well, feather in the cap is typically a good thing, right?
Well, yeah,
Yeah.
more often, but
So this is
negative.
maybe a
Yeah.
removal of the feather in the
Feather in the
cap.
cap.
Getting
Yeah.
the reversal down. I mean, historically speaking, right, this is one of those times where you just say, okay, we're still in very strong levels. Participation is still strong. It's not like we fell down to 50. It's not like we had a humongous washout day or something like
Mhm.
that. But for the most part, right, what you're looking at is a bit of an exhale. And this is something that we've been calling for, right? I mean, you think back to the last couple of podcasts with myself and I think it's been Ian for the last couple. But we've been sitting here and saying, hey, a normalization is necessary, right? We would love for
Mhm.
stocks to go up every single day, but unfortunately, it doesn't happen like that. So just again, to quickly define, the BPSPX measures the percentage of stocks that are on point figure buy signals. So an intermediate term picture. So we got a reversal. That means more stocks are on sell signals, which is not necessarily a good thing. But again, it's not as bad as the language would imply. Let's put it
Right.
that way.
Even looking at the indicator, you could just say roughly 7 out of every 10 stocks within the S&P 500 still maintain a buy signal.
Right.
That's healthy. And I mean, in a way, what is seeing that reversal occur along with sort of how market indices have behaved? Um, gives you an idea that there's just fewer participants that are participating in that contribution to the market moving to new highs.
Yeah, I'm gonna butcher this, but I saw like it came out in the chart report, which is like a daily deal. They send you a bunch of charts that are out on Twitter. It was sometime last week. It was like we just had the best performance day while at the same time the worst breadth day. It was they put a cool chart on there. It was like this was in all of history, which I was like, really? I don't know.
Mhm.
I didn't look at the start date, but it was very, it was like best performing with the worst breadth. Like it was a like a scatter plot essentially.
Mhm.
And it was all the way on the left saying, hey, the best performing, but the breadth was
Least
really
amount of
low.
breadth there. Yeah.
So it was very interesting to see. And it just kind of, again, furthers that idea that, hey, major markets are still marching higher, but it really is going back to more of a kind of a narrow leadership profile.
Mhm.
Nvidia's Mag 7, right? Those type of stocks are doing
Right.
well. So will that continue? We don't know. If we did, we'd be on a beach, but that'd be well,
Well,
it'd be fun to watch.
the benefit of looking at even this right now and still realizing that there's an elevated level, while we're saying, oh, there's not as many give it contributing to the highs
Yeah,
here, the elevated level simply is stating also, in another way, is stating that you're seeing consolidation out of the rest of those. They're
right.
not falling apart. They're not breaking down. They're simply just kind of working their way sideways, at least in the very, very near term. And like we've talked about, we've been looking for consolidation. We've been wanting to
Yeah.
find some point. And I think maybe we're sort of getting it, but not quite just yet.
No, it's a good point. And speaking about the Magnificent Seven, what often doesn't get talked about is the other 493. And so a
Hmm.
good way to look at kind of the other 493 is to give them an equal vote. And so our fourth chart for the day is going to be the S&P 500 equal weighted index, which does exactly that. Now, over the last week or so, this has reversed back down into a column of O's. It still, just to open the conversation, maintains a pair of buy signals and is well within a positive trend, or lies well within a positive trend at the time of this recording. So the reversal down, again, is just a symptom of that decreasing breadth. I think where bears will probably come in to have a point here, and it's a valid point, is the fact that we couldn't get to those all-time highs like we could from the cap weighted side of things.
Hmm. Yeah, I mean, in a way, is that sort of going back to where we're thinking, you're just not seeing as many participants from those smaller names,
Yeah.
but it's almost when we talk about a relative story, you're just seeing a further higher magnitude from the larger names than you are these smaller names. It's not like this particular picture is bad and
Right.
the other's good. It's just one slightly better than the others.
Well, and that's the beauty of relative strength. I mean, this is something that you can say, hey, both of them are good, right? If two stocks are up for the year, one is up 30, one is up 20. Now that's not where we are, but
Right.
for the sake of it,
Hypothetically.
one's up 30, one's up 20. Well, hell, you look back at it in the grand scheme of things, both are great, but you'd probably be
Right.
better suited to be in the one that's in 30, right? And so using relative strength can help you identify, hey, one stock is this, another stock is this. You can choose between two indices, two assets, whatever it is, based on which one's doing relatively better.
So when we're in this environment that you're seeing slight pullbacks out of the S&P equal weight and also, the S&P 500 moving to new highs, and we're sitting here talking about in a scenario that one's up 30, one's up 20,
Right.
it's a good problem to have
Yes.
in a way. It may seem frustrating when you're trying to pick individual stock positions, but in a sense, it's a good problem to have that things are positive and we're simply just trying to pick what's more positive.
Yeah, there you go. And as you mentioned, right, what is more positive? You look at the kind of cap weighted S&P 500 at all-time highs. A lot of you probably have clients. I know that we have clients calling in saying, Miles, David, whatever your name is, hey, John, they're calling and they're saying, what do I do? Right? We've laid out a roadmap throughout your financial future. What do we do around all-time highs? Essentially, they don't want to buy in right now, right? Perceived value of an overbought market at all-time highs isn't that great.
It's almost like it gives people the initial thought of like, oh, it's an all-time highs. What's the next step? It's
Right.
got to go
It's got to go
down.
down, right? It's anchoring. Essentially what it is, they
Right.
put something called anchoring bias, or, maybe they don't want to be a greater fool or whatever it is.
Mhm.
But to kind of combat that or test that idea, what we did in our most recent feature was we had put together three hypothetical portfolios or three hypothetical, and this is the table on the chart right now goes through each one of those portfolios. We put together three hypothetical clients. One who just invests or contributes $500 to a portfolio, starting with $100 in 1950. So going back 75 years here, they start with $100. At the end of every month, they contribute $500. So they're just your simple baseline, your dollar cost average in a master here.
Mhm.
You then have two essentially other possible clients that might be what you all are experiencing. You have one client that does not want to buy at all-time highs and when markets are overbought. So he will wait to invest his money until markets are not overbought or near
Mhm.
all-time highs. So there's your second investor, again, trying to contribute as normal $500 unless we're overbought. Then he'll wait.
Mhm.
You then have a third client who's more of a scaredy cat, the scared investor, right, over on the table that you are looking at. This client will invest $500 as normal unless we're overbought near all-time highs, just like the second investor. At that point, he will save those contributions and only invest them when the markets are then oversold. So he's trying to time the market, right?
Mhm.
What it turns out, as you can see throughout the entire history, is that average Joe portfolio, right? The one on the far left here, the one who just dollar cost average in no matter what, they have the most productive portfolio, right? They're the ones, I think it grows to like 24 million, which is incredible, the power of
Mhm.
compounding.
Mhm.
But the point is that looking at that portfolio versus either one of those other clients who are scared of buying in some way, shape, or form, scared of buying at all-time highs, they miss out on what equivalent over the course of 75 years is a nice car, a house, a nice boat, whatever it is. All that to say, we can't prevent our clients from being scared around all-time highs, but we can have empirical evidence that says it's about time in the market, not necessarily timing the market.
Yeah.
I took your thunder. That's what you wanted
Yeah,
to say.
that's totally
But
fine. I mean, literally, when you're talking about it, that's the theme that just exudes through the data is that, many people think it's about timing and picking the right stock or the right position, and that's how somebody makes money or generates wealth. And
it certainly can't happen like that.
it's happened,
Yeah.
but you're talking about batting averages, low batting averages then, and like even a baseball player has a better chance of hitting home runs. It's just it's super rare to hear that, and you hear the stories because yeah, there's enough of them, but you don't hear them from every single person that's
Right.
invested, and that's part of it is more of us that have put the time in, put the in, and ultimately been in the market have seen greater benefit just because at this point, rather than trying to pinpoint exactly where things should be, you're better along just going going along with it. Maybe
Correct.
kind of playing, we look at hedge and defensive ways to help ourselves out in the short term, but in
Well,
many
it smooths
cases,
the ride.
it
Yeah.
smooths the ride out, but and more often than not, you're better off leaving your portfolio to work or leaving your money to work
Right.
in some
Rather,
fashion or form.
yes, just and keep putting it to work. That's the thing. I
Yeah.
mean, do that. Just to wrap up with the rest of the image, some of you might say, oh, well, it's unrealistic to look at data all the way back from 1950, 75 years worth of data. Contributions will change, etc. And yes, I would concede that that's partially true. But again, just to prove the point, we've looked at other instances. So 1980 with the initiation of the first kind of 401k
Mhm.
contribution and things like that, going back to 2000 with the kind of more near term, all the math is essentially the same. Where though that guy who's just buying the market week in, or excuse me, month in and month out, does better than the guys who are trying to get cute and avoid buying strong or overbought markets at highs. So take that as you will. Just a bit of empirical evidence as we move into Q3. Last words?
No, not too many at this point.
Okay.
Thanks for joining our podcast as always, and I believe we'll be back next week to talk about a new group of five charts.
Yes, that's the truth. Have a good one.